You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved, back from a mid-November Thanksgiving hiatus, and really excited about this series. This is actually our first 5-episode series we're doing. Happy to have Scott Dolson, partner at Frost Brown Todd, joining me today to do QSBS Masterclass is what we're calling it. The idea behind this Masterclass series is to take 5 of Scott's most foundational QSBS-related articles and turn them into podcasts. And some of you will also see this on YouTube. So really excited to have Scott Dolson here to talk through just a little bit of his extensive writing that he's done on QSBS over the years. Thanks for joining, Scott.
Yeah, no problem. Appreciate it.
I was trying to find it right before we jumped on, and I've talked about this before on the podcast, but I have a book. It's about 600 pages, mostly of Scott's writing that I put together, PDFs over time. And I've been in the QSBS game for about 2.5 years, and Scott's been in it multiples longer than that. So very, very glad to learn from you over time, and hopefully we can provide some good information here for listeners.
Yeah.
So this will be a 5-part series, and this first part that we'll focus on this episode is based on an article called "Maximizing Section 1202's Gain Exclusion." And so what I want to do here, Scott, is go over just the fundamentals of Section 1202. What is QSBS? Why? Maybe answer some questions about why there isn't any advising infrastructure around it. Generally in the U.S., there are only a few attorneys who really specialize in it. And then hopefully give some useful tips for ways that QSBS can be planned around and maximized. So let's start just sort of the basics of what is QSBS, short and sweet of what it achieves for folks who can take advantage.
Yeah, I mean, it's qualified small business stock. Congress enacted Section 1202 in 1993. For the purpose of trying to incentivize investment in C corporations. And at the beginning, there was a gain exclusion. Each taxpayer could exclude $10 million of gain, but of that $10 million, only 50% was really excluded. So you had a 0 tax rate on 50% and a 28% tax rate on the other 50%, and you had some additional tax on the portion that was taxed. So really, back in the day, when we had a period of time there where we had a 15% capital gains rate. So really, 1202 was kind of, it was there for people who were going to do C corporations anyway. So maybe, that Silicon Valley people where it's all driven by preferred stock investors would default to that. But the rest of the country, including me and everybody else, and this is probably, why you don't see a lot of infrastructure, all the LLC acts were passed back in the beginning in like 1988 up through the mid 90s. So that, the whole country sort of was enamored with the limited liability company, right? Nice combination of partnership tax and liability shielding for all the owners. And so we all became, sort of experts on drafting operating agreements and, advising. And if you're the business person, operating through a partnership for tax purposes. So I think that's kind of where it is actually for a lot of professionals across the country. And while, maybe within, 50-mile radius of Palo Alto or something, everybody's like, we're all going to do C Corps. the rest of the country is just starting to come around over, I would say, the last, basically since the corporate rate was reduced to 21% in beginning of 2018. I mean, I think there were sort of two magical inflection points or points. One is in mid 2010, they increased the gain exclusion from 50% to 100% for stock issued after that date. And then, roll forward, they reduced the corporate rate from 35 to 21% beginning in 2018. So you had a good combination there. It became a really powerful planning tool. So, I mean, basically, if you own qualified small business stock, you've got to meet all these eligibility requirements that we'll talk about, off and on in the next couple of hours of these podcasts. But, if you qualify, every taxpayer had a $10 million gain exclusion. So, that's from capital gains. So, on $10 million, if you actually had that much, that's $2.38 million in tax savings at the federal level. And I think right now it's about 47 states follow federal, and New Jersey will start following federal January 1. So I think it's Pennsylvania and California don't. Big surprise about California, right? Yeah. So, it's an incredible gain. It's an incredible tax benefit, but it's a very niche thing in the sense you've got to meet all these eligibility requirements. But for those that do, it's the best thing since sliced bread, obviously, from a federal tax standpoint. So that's kind of the background on it. I mean, there's certain companies that are types of businesses that are excluded, primarily sort of professional related or real estate, hotels, restaurants, that type of thing. But, manufacturing, life sciences, all the software companies, pet stores, we've got those, plumbing companies, supply companies, a lot of service businesses that are like in training, different things. You take the big pie of all the possible business activities, it's really only a fairly discrete slice that's carved out and not eligible. I mean, important things like law firms and, physician practices. But, you look at Main Street, all the businesses out there, they probably almost all qualify if they wanted to operate through a C corporation. So that's where we get into a lot of the planning of, do you want to do that? Yeah. Because, that carries with it a lot of, baggage, but then if you get this gain exclusion down the road, when we model that out, I mean, that's like the grand slam of sort of tax planning, sell your business, potentially avoid paying any federal income taxes.
Yeah, it can certainly work on Main Street. One of the issues though that we see is on the transaction side, because QSBS functionally requires a stock sale to be triggered, and so there are some industries and sectors, Scott, maybe just spend a minute on this, but some industries and sectors where stock sales are just not common ways of companies achieving liquidity. Maybe asset sales, or if you think of family-owned businesses, maybe like a lawn care business, just say no one's selling the stock of their lawn care business; they're selling the tractors and the customer base. And so that, I think that's one big reason why we primarily see QSBS on the coasts in our tech companies in New York and California. And obviously, as you said in the start, it's really an exclusion that was tailor-made by and for the venture industry, technology companies and other companies that are backed by institutional venture capital. And I think one big misconception that people have, though, is that QSBS is only for tech companies. And the reason people believe that, I believe, is because well over 80% of the venture capital that flows into startup businesses flow into technology businesses, SaaS companies and consumer tech companies. And so, yeah, there is a lot of opportunity for non-tech businesses, and even, as Scott said, Main Street businesses to be QSBS if they have the right conditions.
Yeah. So, I mean, three things. One, I think, I'd be interested in getting your thoughts, but I've seen QSBS migrating well beyond venture over the last 3 or 4 years. I mean, family offices, private equity firms, private equity used to not be in the loop, now they seem to be much more in the loop, and even individual entrepreneur, buyers of businesses are all starting to become more attuned to 1202. And there's no express limitation at all in 1202 to the venture area. I mean, it first picked it up, right? I mean, they're the people that promoted the National Venture Capital Association is behind in terms of lobbying for some of these changes, all those organizations, but it can be used by anybody. So, I mean, that's one thing. Another thing, and maybe I forgot the third, but another thing is in terms of buying assets like lawn care, okay, got some lawn care clients, have some roll-ups of lawn care businesses. So you see that, and you do see stock purchases in those roll-up transactions. It seems like the sophisticated financial buyers are used to buying at stock, and focusing on, is it accretive to earnings versus, sort of penciling out the lost goodwill amortization. I'm not saying it doesn't happen, but you do see stock purchases. And the third thing is, and we get into a lot of this. I was speaking at Tulane 2 weeks ago. They have a big tax institute every year, and my topic was choice of entity, comparing partnerships to C corporations, and discussing quite a bit the modeling that we're doing about, how this models out. You've got the end result of the exit, and then you've got the annual result of, okay, you're making money, what happens to the money? And if you model out the exit, and that's pretty easy to do, I mean, there's really 4 different things to look at. One is you switch to a C corporation, everything works out, and you sell the stock, complete home run from a tax standpoint. I mean, it can't get any better than that, right? If the company appreciates a lot. Mm-hmm. Second possibility is, we're a partnership, we convert to a C corporation, 6 months later, lightning strikes, somebody comes in and offers us some ridiculous amount of money, and they say, we only buy your assets, and it's so much money, it just overwhelms the tax consequences. That's sort of the strikeout. The other strikeout would be you don't qualify for 1202, and you thought you might, But that thing where they come in and offer the money before you hit the holding period requirements for 1202, I mean, it can happen. And, I guess it's kind of a first world problem, right? You're getting so much money, you'll take that deal and sell assets. You'll wish you were still a pass-through entity. So that's kind of down on the other end of the spectrum. Either it's a failed 1202 attempt, or you just don't have the holding period and you sell. Now, you could roll over under 1045. So, that's a possibility. And frankly, I mean, I've had people come to me and say, we're a partnership. We think we'll sell next year. We want to incorporate, get our 6 months in that's required under 1045, because we know where we want to roll the money over, which I think, that's kind of a little bit of a, there's a lot of moving parts there, but I mean, it is, I've heard that strategy more than one time. So you got the home run, I'll say the strikeout or whatever you want to say about it. And then there's the middle thing. And this is why I'm really sort of making this speech about this. The middle thing is, we're 6 years into this, so we can claim 1202 if we sold the stock, but they won't buy the stock. They'll only buy the assets. So we sell the assets, 21% tax at the corporate level. And then guess what? We adopt a plan of complete liquidation. We liquidate the corporation, and the shareholders can claim 1202 on the liquidation. So where are we there? So then the other in the middle one that we're comparing that to is, we stayed a pass-through, okay, and we sell assets. And that sale of assets is going to be a mixture of ordinary income, like, cash-based accounts receivables and long-term capital gain assets. So the middle thing is we sell the assets of the corporation, flat 21% tax. The other possibility is we sell the assets. We've got, and it's going to flow through on a K1, right? Or, sole proprietorship, and we're going to have capital gain on part of it, right? Which is more than 21%, 20 plus 3.8 for the Obama investment income tax, right? And we might have some ordinary income assets. Hard to know what percentage, but some at least. So really, when you think of those two middle scenarios, they're pretty close. I mean, I'm not going to try to promote 1202 over, the S Corp or the LLC in that middle category. I mean, they're kind of close to each other.
Yeah. And I mean, in terms of choice of entity, it's hard to make this decision early on in a company unless you are a venture-backed, venture scale, expecting high growth company where the goal of the business is to have a stock sale in, say, 5 to 7 years. Scott probably sees way more of the not Main Street business, but like the family business, S Corp business in the in-between states where some of this like conversion work is really important. Hey, we're going through a transition, maybe among family, or we're trying to sell a large portion of the company. That, you really do have to pencil out the math. But for our venture-backed startup founders in tech or otherwise, there's almost no situation unless you're looking to create a lifestyle business that maybe cash flows a ton, and it's still in one of those sectors. But if you're receiving venture funding and you need a $500 million or $2 billion exit, it's going to be a stock sale, most likely at the end of the day, and you're going to hopefully be able to benefit from QSBS. So there's definitely two types of businesses. You need to know which one you are before you make some of these decisions in terms of what your long-term exit goals are.
I mean, for the venture firms, it might be preferable. When I say venture firms, like the technology company, the AI company now out in California, let's say, it might be better off for them to operate as a partnership for a while. And then, our topic here, this 10x gain exclusion would be, very powerful, but most of them default to the C corporation from day one because, people want to buy the safe instruments of the C Corp. And then, the first price round of preferred stock, they want to be a C corporation. But I mean, we do work with people who deliberately are operating as a partnership because the strategy is we're going to get ourselves. I mean, I had to get valuations to make sure in several instances. Well, we almost always get valuations, but in some cases we really were bumping up against the $50 million number in terms of value, which, was the cap basically on being able to, successfully put all the property into the C Corp. I mean, you could hold some out, but I mean, the strategy there was, we're doing, the typical one, we're doing roll-ups of, you name it, whatever it is, lawnmower services, and we're going to, instead of starting as the C Corp, which gives you the holding period. So, I mean, that's a benefit, right? That's a big deal, but we'd rather, we model or whatever you want to say in 18 months, we're going to scale up to $15 million on this thing. So that's when we're going to incorporate. And if we incorporate when it's 15 million, then we can, we don't get the 1202 gain exclusion on the first, let's say the tax basis is zero in the assets. Okay. We don't get it on the first 15 million, but then, the next 150 million, we get it. And, most of these people are thinking those kind of numbers. I mean, you don't get the thing where they're thinking 30, we're 15, it will be 36 years from now. Typically these people, it's 15, we're going to be 200. And there, the 10X is really big. So, there are people that are pursuing that.
Yeah, let's stop there, Scott, and we'll just name the two main uh, caps
Yeah,
for QSBS, and then that'll get to this maximizing part, which is really part of this article that we're basing the conversation
right.
of. So you have to have stock from a C corp, and you have to hold that stock for 5 years to qualify for the gain exclusion. So let's start with the first one. If you don't hold the stock for 5 years, say you sell your company at year 3, or even you sell a portion of your stock, maybe through a secondary sale at year 3, you really only have one option in terms of maintaining QSBS, and that's to do what Scott's alluded to and what our firm focuses on, which is 1045, a QSBS rollover. And that's taking the cash, the cash that was wired to your bank account from that sale, and reinvesting it into new QSBS eligible stock. And what that does, Scott, is it continues the holding period, and it continues the basis that you have in the company. So you roll over, just say $5 million into a new company, and that the basis in that new company is maybe $0, what you had in your original. And so it's really the only way to continue your QSBS eligibility if you sell short of 5 years.
Yeah. I mean, so just to get to your thing, I mean, there's two caps. I call one the standard cap. That's a good way of looking at it. The standard cap is a per taxpayer $10 million cap. And that's for stock issued prior to July 5th of this year. Starting July 5, stock issued on that date or later, is a $15 million gain exclusion cap. And the other cap is this 10 times your tax basis. They kind of work in parallel with each other. We can do planning where, you could maybe sell and get the 15 or 10 million and then still have some stock with tax basis and get more gain exclusion. And then, we'll talk about this, and then we try to maximize it by gifting. But on what you said on the 1045, I mean, 1045 is a powerful tool. I mean, it's really just an additional benefit, I think, that Congress put in there to encourage that initial investment, that you have this opportunity to kind of keep the ball in the air. If you go to a C Corp and you sell in 2 years, your options are, one, 1045, reinvest in another qualified small business stock investment. And the other possibility would be, get stock of the buyer. But typically the buyer is going to be larger than, they're going to be a whale that's going to not qualify for the $75 million test, the limitation on size. So what will happen then is the only gain exclusion you would get would be the value, the spread at the time you did the exchange. So if you had sold then, what would be the capital gain? That portion you could claim 1202, but not the excess if Apple buys you or somebody like that. So 1045 gives you some pretty, sexy planning opportunities of spreading money among one or more replacement investments. And each one of those is a separate issuer of qualified small business stock, which may sound crazy, but it's sort of like you start with Corporation A, you sell its stock, you theoretically could invest in B, C, and D. Each one of those is a separate issuer, and you would have a separate gain exclusion in each one of those. I mean, and the holding period's there. So, I mean, a crazy scenario would be, somebody's probably had it happen. You take $100 from the Corporation A sale, you had 3 years on it, you roll that $100 into your new company, buy founder stock for $100, and then you start with founder common stock with a 3-year holding period. I mean, that's kind of a crazy thing, but it's literally the way 1202 and 1045 work.
Yeah, I mean, that's the type of situations that we see all the time, because I think that people don't realize how often early quote unquote sales happen before 5 years. We see them most often when a founder is raising maybe like a Series A, B, or C round, and they take secondary of some kind during that transaction. And most of the time, especially if it's at, say Series B, it's happening before 5 years. So we see a lot of, say, $3 to $5 million liquidity events at those stages happening before 5 years. And shoot, now with these AI companies, companies are selling within a year or two. It seems like everyone is trying to grab up these startups.
Yeah, that's a good point, that this could easily happen, not for the sale of the whole company, but the founders tag along with a priced round and are selling some of their founder stock, and it's QSBS, but they don't have the holding period. Yeah. So, I mean, I could definitely see that happening. And, one of their, so they want to diversify. So you guys can help them diversify out of, having all their wealth into that company that they obviously are having a success with, but take it and reinvest some of the proceeds into other investments. Yeah.
Yeah. So there's the before 5 years, then there's the $10 million or now $15 million, which we aren't seeing a lot of quite yet, just because of we're still in 2025.
Yeah, we got ways. And we on the, now it's 3 years, you get a 50% gain exclusion on new stock, recently issued. And after 4 years, 75%. I mean, the problem with 50% and 75% is the portion that isn't excluded isn't taxed at 20%. It's taxed at 28%, which is just kind of a fluky thing under the code, section 1H, I think. And so the numbers aren't as compelling, but it is another safety valve, I guess, possibility. But, I think if you've got a good 1045 reinvestment opportunity, you can keep the whole thing, the entire ball in the air, and shoot for the 100% gain exclusion. So it's nice having various options, but, the grand slam there would be, you sell out your stock after 2 or 3 years, and then you reinvest it, and you have a success on the replacement QSBS sale, down the road.
One of the morals of this story then is, if you have QSBS stock, if you sell before 5 years, we can help you. If you make more than $10 million, there are ways that you can be helped. You can't be helped if you're not issuing stock as a C Corp. You can't be helped if you actually are a law firm and you thought you were a tech company. So there are some criteria where it's kind of hard line in the sand. There's no strategic planning that can pull you back from the ledge. And there are other things where you certainly can maximize QSBS in the two sort of restrictive situations that we just talked about. Scott, and the last thing maybe we can get into here in terms of maximizing QSBS is QSBS is granted to each individual taxpayer, and can be granted from many individual corporations, which you've also already alluded to, right? Say You have 3 different investments in 3 different companies, you can receive a QSBS exclusion in each of those.
Yeah, separate one.
A little about the taxpayer, per taxpayer benefit.
Yeah, so if I get QSBS from Corporation A, and I'm fortunate enough to be sitting here saying, I've got $50 million worth of Corporation A QSBS, I can do. And let's say I'm a founder and I really don't have any tax basis at that point. At that point, when I see this kind of freight train coming, what I can do is gift planning, because under 1202, my other option is to die, but most people don't pick that one. So if I die and it gets left to 4 beneficiaries, it gets split among taxpayers. But if I'm alive and I want to do something, I can make gifts. And, you can make a gift to an individual. You can make a gift to a trust set up for an individual. So Brady, if I wanted to give you stock, but you're one of these guys that would immediately go out and buy a Lamborghini and stuff, I might set up a trust that doesn't really let you do that, but you own the stock. So you're the other taxpayer. And then, when you're 80, you get the money or something, that kind of, trust for kids, that kind of thing. And the other one is I can set up one of these, what I call asset protection trusts. There's certain jurisdictions, states that have statutes that kind of dovetail with the federal trust statutes. Delaware was the first. Nevada came in. Now Tennessee, Ohio, Alaska, North Dakota. I don't know, maybe there's more of them now. But in all of those, you can set up a trust where the thing that's special about those, they were designed to protect your assets from creditors originally, but they can be used because they're a separate taxpayer for federal income tax purposes. And because of the way the statutes read, the grantor, gifting the stock into that trust can be a contingent beneficiary. So it's possible with those trusts that I could end up getting the money back. So those trusts, they're more expensive to set up. They're more complicated, but they could potentially allow me to, put money in and maybe, 6 or 7 years, see some of it back. So that's one of the possible ways to maximize the gain exclusion. Another possible way is to do what some people, and I almost wish people wouldn't use these terms because it just sort of sounds bad, that stuff the corporation. So what that means is you get a 10x gain exclusion on your tax basis of assets that you have in the stock of a corporation. So let's say I'm sitting here on 50 million worth of stock, and let's say the corporation, wants to raise money. It needs money for operations. Let's say this is a pharma company. That's classic, right? So they're doing a debt offering. Or I could say, no, I don't want to do that, but I'll buy preferred stock, and I could buy some preferred stock, qualified small business stock, if the company's still below the threshold, which those pharma companies, they keep getting money, burning them off, and their aggregate gross assets stay low. I could buy, let's say I buy $5 million worth of stock. So that's QSBS. And even if I sell, let's say I sell a year later. So I obviously don't have the 5 years on the stock I bought a year earlier. But what happens is if I sell all my stock, you look at my aggregate tax basis. And if that's 5 million and all my stock just got sold for, let's say, 60 million, well, I now can claim the 10x gain exclusion cap of 50 million. The critical thing in my mind is, was there a bona fide reason to put the money in? Because, to me, I wouldn't want to be in a situation dealing with the IRS where we stuff the company. And this is where that term, we're stuffing it like it doesn't make sense, putting money in, contributing property just to get stock, just to claim the 10x gain exclusion. But, there are situations where I have personal goodwill or I have money, and that needs to go in that corporation. That's number two. And number three is way back when you and I set up the whole arrangement of a company in the first place. Some companies ought to be multiple corporations, separate brother, sister corporations. It doesn't make any sense to have, let's say we have two activities that really ought to be separate because they have different investors, different buyers potentially down the road. Let's do some thoughtful planning up front because each one of those is a separate issuer and I get a separate gain exclusion with both of those. So, those are three different ways to be thinking kind of creatively or whatever you want to say about it to try to get more than what I would call the standard, if you're lucky enough, let's say the standard gain exclude.
Yeah, maximizing is really, I guess, about two things. It's about extending, either maybe it's extending your holding period or it's expanding the amount that you can take excluded from capital gains. Those are really the two strategic categories, right?
And we can be Peter Thiel and what we can buy essentially founder stock in a Roth IRA, I guess he had the deal. He must have had the deal where he wasn't an insider, so he didn't have the limitations on investing in this stock, but he got it priced at like the penny founder stock twice over in a Roth IRA. And that's how you get $5 billion in your Roth IRA. So for those of you listening to this who are in that situation, that's what you ought to do. Otherwise, I wouldn't be recommending putting your money in putting your stock in the IRAs.
Yeah, you can't die at 50 if you do that either, because that's not going to help you. Your IRA is not going to help you.
Yeah.
Great. Yeah, that's maximizing QSBS. I mean, there's many more hours that we could go into, and actually our next part 2 of this series will deal with finding good rollovers to extend the holding period for QSBS. So thanks, Scott, for this part 1, and jump over to part 2 and keep listening with us. Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.